The United States government owes $37 trillion. It's more debt than any nation in human history. It's more debt than the entire global economy produced in a single year just 2 decades ago. And here's what most people don't understand. They're not planning to pay it back the traditional way. Throughout history, governments facing massive debt have used specific strategies to reduce the burden. And understanding these strategies is crucial for your financial future. You're watching how the U.S. government might handle the most significant debt challenge ever faced. They're discussing strategic reserves in Bitcoin and gold, and understanding what this means could be the difference between preserving your wealth and watching it erode. But here's the part you need to understand. When governments manage debt through monetary policy, it affects everyone holding dollars. Every dollar you hold could lose purchasing power. Every bond you own faces inflation risk. Every savings account could decline in real value. This isn't conspiracy, it's economics, and it's happened before. In this video, I'm going to show you exactly how this works. It's not speculation, but the actual historical patterns of how governments have managed unsustainable debt. I'll show you the historical precedent because this has happened before multiple times. I'll show you what the U.S. government is doing right now with Bitcoin reserves and gold holdings. And I'll show you what you should understand about protecting your wealth. Because understanding economics isn't about fear, it's about being informed. The pieces are moving, and understanding them helps you make better financial decisions. Let me start with something most people don't understand. Government debt is not like household debt. When you owe money, you have to pay it back with real value earned from your work. But governments have tools you don't have. They control monetary policy. They can influence inflation rates. They can manage currency valuation. This is called monetary policy, and it's been used repeatedly throughout history to manage debt burdens. In 1933, the United States was struggling with debt from World War I and the Great Depression. The debt-to-GDP ratio was around 40% and climbing. The economy was in deflation, which made debts more burdensome, so President Franklin Roosevelt did something significant. He changed the gold valuation. Here's how it worked. In 1933, gold was officially priced at $20.67 per ounce. That had been the price since 1879. The dollar was defined relative to gold under the gold standard system. Your dollar represented a claim on physical gold, but the economy was in crisis. Roosevelt issued Executive Order 6102, which required Americans to sell their gold to the government at $20.67 per ounce. Most Americans complied and traded their gold for dollars. Then in 1934, he announced the new official gold price at $35 per ounce, about 69% higher. Here's what that accomplished. The government held most of the nation's gold after the collection. At the old price, their reserves were worth less. The new price, those same reserves were worth more on the books. This helped address the deflation crisis. But here's the key lesson. The debt was denominated in dollars. The policy changes that followed, including moving away from strict gold backing and allowing some inflation, reduced the real burden of the debt over time. This isn't about conspiracy, it's about economic history. Government used monetary policy tools to address an economic crisis, and it affected everyone's purchasing power. The United States currently owes $37 trillion in debt. The debt-to-GDP ratio is around 120 to 130%. Depending on measurement. That's higher than any time in American history except World War II and its immediate aftermath. The annual interest payment on that debt is over $1 trillion. That's more than the defense budget. It's more than most other budget items. And if interest rates remain elevated around 4 to 5%, these payments could reach $1.50 to $1.8 trillion annually by 2027 or 2028. This presents a significant challenge. Everyone understands this. The Congressional Budget Office has published reports on it. The Treasury discusses it. The Federal Reserve factors it into their decisions. There is no easy scenario where this debt gets managed through traditional means alone. You cannot realistically raise taxes enough to close deficits of this magnitude without economic consequences. You cannot cut spending enough when interest payments alone consume such a large portion of the budget. Economic growth helps, but growth rates aren't high enough to solve the problem quickly. This leaves monetary policy as a significant tool. Monetary policy that reduces debt burdens also creates inflation, which affects purchasing power. Enter the discussion about Bitcoin and gold reserves. Let me show you what's actually happening. On January 23, 2025, President Trump signed an executive order related to digital assets and cryptocurrency. The stated goals include positioning America as a leader in digital assets and supporting innovation in the crypto space. Senator Cynthia Lummis has introduced legislation proposing a strategic Bitcoin reserve. The proposal suggests the U.S. could acquire and hold Bitcoin as a strategic asset. The stated goal is to ensure the U.S. doesn't fall behind other nations in digital asset adoption. That's the public narrative. Now, let's discuss the economic implications. The U.S. government currently holds approximately 200,000 Bitcoin seized from criminal cases like Silk Road and various fraud investigations. At current prices, around $100,000 per Bitcoin, that's roughly $20 billion. It's not insignificant, but not enough to address a $37 trillion debt situation. The proposed legislation discusses acquiring up to 1 million Bitcoin over several years. At current prices, acquiring that much would cost around $100 billion if purchased directly from markets. Here's where economics gets interesting. Some analysts speculate about potential revaluation scenarios. If the government accumulated significant Bitcoin holdings, and if Bitcoin's market price increased substantially, this would increase the value of those holdings on the government balance sheet. Similarly with gold, the U.S. officially holds about 8,133 metric tons of gold, currently worth approximately $650 to $700 billion at market prices, around $2,700 per ounce. But here's something interesting. On the government's official books, gold is still valued at the statutory price of $42.22 per ounce, a relic from 1973. This creates a massive gap between book value and market value. Some economists discuss scenarios where official valuations might be updated. Let's think through the economics. If Bitcoin's market price rose to $500,000, or $1 million per coin, over time, due to increased adoption and demand, holdings of 1 million Bitcoin would be worth $500 billion to $1 trillion. If gold's market price rose to $10,000 or $15,000 per ounce, which some gold bulls predict, U.S. gold reserves would be worth $2.60 to $3.9 trillion. Combined, this could represent several $trillion in strategic reserve assets. However, here's the critical economic point. If Bitcoin rises from $100,000 to $1 million, what does that tell you about the dollar? It suggests the dollar has weakened significantly relative to Bitcoin. If gold rises from $2,700 to $15,000, it suggests the dollar has weakened relative to gold. Asset price increases in dollar terms often reflect dollar devaluation, especially for assets viewed as stores of value. This is the mechanism some analysts worry about. Strategic reserve accumulation followed by significant price increases in those reserves often correlates with currency devaluation. Reserves gain value in nominal terms, but the currency loses purchasing power. This is essentially what happened in various forms throughout the 20th century. Now let me discuss gold specifically because there's historical precedent. The U.S. holds 8,133 metric tons of gold. At $2,700 per ounce, that's worth about $706 billion. But remember, it's on the books at $42.22 per ounce, making the official book value only about $11 billion. This gap has existed for decades. Some economists have discussed updating gold's official valuation. If gold were revalued on government books to $10,000 per ounce, the reserves would be worth about $2.6 trillion. At $15,000 per ounce, about $3.9 trillion. This doesn't magically eliminate debt, but it changes the government's balance sheet appearance. It could provide justification for certain monetary policies. And here's the concern. If the U.S. led a movement toward significantly higher official gold valuations, market prices would likely follow over time because the largest holder influences the market. And as gold rises dramatically in dollar terms, it reflects dollar devaluation. Let me show you what this means in practical terms. Imagine you have $100,000 in savings today. You're comfortable, not wealthy, but stable. Now imagine over the next 5 to 7 years, we experience average annual inflation of 5 to 7% instead of the typical 2 to 3%. That might not sound dramatic, but compounded over time, it's significant. At 6% annual inflation for 7 years, Your $100,000 would need to become $150,000 just to maintain the same purchasing power. If your savings just sit there, you've lost 1/3 of your real wealth. But if inflation ran higher, say 8 to 10% annually for several years, which has happened historically during periods of high debt resolution, the impact is much more severe. At 8% inflation for 7 years, you'd need $171,000 to match your original purchasing power. Your $100,000 would only buy what $58,000 bought before. That's a 42% loss in real terms. Meanwhile, the government's debt burden decreases in real terms. The $37 trillion they owe is in nominal dollars. If significant inflation occurs, they're repaying in dollars worth much less than when they borrowed. This is how governments have historically reduced debt burdens without technically defaulting. It's not conspiracy theory. It's documented economic history from multiple countries over multiple decades. So what should you understand? First, diversification becomes more important during inflationary periods. Holding all your wealth in cash or bonds that pay fixed interest rates exposes you to significant inflation risk. Second, assets that historically preserve value during inflation include stocks and companies with pricing power, real estate that generates income, commodities including precious metals, and potentially Bitcoin, though it's newer with less historical data. Third, understanding this isn't about panic, it's about informed decision-making. If you understand that governments facing unsustainable debt have historically used inflation as a management tool, you can position yourself accordingly. Fourth, watch the actual indicators. Monitor debt-to-GDP ratios. Watch interest payment trends. Pay attention to Federal Reserve policy statements. And observe what central banks worldwide are doing with gold reserves. Let me talk about gold specifically because it has the longest track record. Gold has been viewed as a store of value for thousands of years. During the 1970s, when the U.S. experienced significant inflation, gold rose from $35 per ounce in 1972 over $800 per ounce by 1980. People who held gold during that inflationary period preserved their wealth. People who held only cash and bonds saw significant erosion of purchasing power. Bitcoin is newer, only existing since 2009. Some view it as digital gold due to its limited supply of 21 million coins. Others view it as highly speculative. The reality is we don't have decades of data showing how Bitcoin performs through full economic cycles. It has shown significant volatility, reaching nearly $69,000 in 2021. It's dropping to around $16,000 in 2022, and recovering to current levels around $100,000. Whether it serves as an inflation hedge long-term remains to be proven. Real estate historically performs reasonably well during inflation because property values and rents tend to rise with inflation. However, higher interest rates, which often accompany inflation, can make mortgages more expensive and slow the housing market. So real estate isn't perfect, but physical assets generally hold value better than cash during inflationary periods. Stocks are mixed. Companies that can raise prices without losing customers tend to do well. Companies with high debt loads or fixed-price contracts struggle. Overall, stock markets have historically kept pace with inflation over long periods, though with significant short-term volatility. Here's my practical advice, and remember, I'm not a financial advisor. This is educational content, not personalized financial advice. First, maintain an emergency fund of 3 to 6 months of expenses in accessible cash. Beyond that, consider diversifying into assets that have historically preserved value during inflation. Second, educate yourself about how different assets perform in different economic environments. Third, avoid making emotional decisions based on fear or greed. Fourth, consider your personal situation, your age, your income stability, your risk tolerance. All these factors matter. If you're young with stable income and decades until retirement, you might tolerate more volatility in exchange for potential growth. If you're near retirement, preservation of capital becomes more important. There's no one-size-fits-all approach. What matters is understanding the economic environment and making informed decisions appropriate for your situation. Now let me discuss what to watch for. There are indicators that tell you about the direction of monetary policy and inflation. First, watch Federal Reserve statements and decisions. The Fed controls short-term interest rates and influences inflation through monetary policy. If they keep rates below inflation for extended periods, that's financial repression, which erodes debt in real terms, but also erodes purchasing power. Second, watch actual inflation numbers. The Consumer Price Index and Core PCE are the main measures. If inflation stays consistently above the Fed's 2% target, that suggests they're tolerating higher inflation, possibly to address the debt burden. Third, watch what central banks do with gold. If central banks worldwide continue buying gold at record rates, which they have been, it suggests concern about currency stability. Fourth, watch government debt levels and interest payments as a percentage of GDP. If these keep rising, pressure for monetary solutions increases. Fifth, pay attention to discussions about Bitcoin reserves and gold revaluation. If these discussions move from proposal to actual policy implementation, it could signal significant monetary changes ahead. Sixth, watch the dollar index, which measures the dollar's strength against other major currencies. A declining dollar index suggests weakening confidence in the dollar. Let me give you some historical context because this matters. After World War II, the U.S. had a debt-to-GDP ratio around 119%, actually higher than today's ratio. How did we reduce it? A combination of economic growth, modest inflation, and financial repression where interest rates were kept below inflation for years. From 1945 to 1980, this combination reduced the debt-to-GDP ratio from 119% to about 30%. But during those decades, especially the 1970s, people who held cash and bonds saw significant erosion of purchasing power. In the 1970s specifically, inflation averaged 7.4% per year. In some years, it reached 13%. The stock market struggled in nominal terms and lost significantly in real terms. Gold soared from $35 to over $800. Real estate appreciated significantly. People who understood what was happening and positioned accordingly preserved or grew their wealth. People who didn't understand it and held cash and bonds got hurt badly. We could be entering a similar period, not identical because economic circumstances differ, but similar in that high government debt may be addressed partially through inflation and financial repression. Understanding this possibility helps you position appropriately. Now, some people ask about extreme scenarios. Could the U.S. experience hyperinflation like Weimar Germany or Zimbabwe or Venezuela? This is very unlikely because of several key differences. The U.S. borrows in its own currency, not in foreign currency. The dollar is the world's reserve currency, used in international trade and held in reserves by central banks worldwide. The U.S. has a massive, diverse economy. These factors make hyperinflation extremely unlikely. However, moderate inflation of 4 to 7% annually over an extended period is quite possible. That level of inflation significantly erodes purchasing power over time without being dramatic enough to cause economic collapse. It's actually the sweet spot for reducing debt burdens because it happens slowly enough that people do and panic, but fast enough to meaningfully reduce the real value of debt over a decade. Let me also address Bitcoin specifically because it's controversial. Bitcoin advocates argue it's digital gold, inflation-resistant due to its fixed supply and the future of money. Bitcoin skeptics argue it's too volatile, uses too much energy, and lacks intrinsic value. The truth is probably somewhere in between. Bitcoin has shown it can store value and transfer wealth, but it's also shown extreme volatility. Whether it becomes a mainstream reserve asset or remains a speculative investment, we'll see over the coming decade. What's interesting is that governments are now discussing it seriously. Senator Loomis's proposal, President Trump's executive order, states and countries exploring Bitcoin reserves. This shows Bitcoin has moved from fringe technology to mainstream discussion. Whether that results in significant government holdings remains to be seen, but the discussion itself is notable. Here's what I want you to take away from this video. The U.S. has $37 trillion in debt, a real challenge that will be addressed somehow. Throughout history, governments facing unsustainable debt have used inflation and monetary policy to reduce the real burden. This affects purchasing power for everyone holding cash or bonds. Understanding this helps you make informed financial decisions. Diversification across different asset types, Some inflation-resistant provides protection. Watching actual economic indicators rather than predictions helps you adjust as situations develop. And most importantly, making informed, rational decisions rather than emotional or panic decisions serves you better long-term. This video is for educational purposes only. It is not financial advice. I am not a financial advisor. Everyone's situation is different, with different goals, time horizons, and risk tolerances. Consider consulting with a qualified financial professional for personalized advice. Do your own research. Understand what you're investing in. All investments carry risk, and past performance doesn't guarantee future results. If you found this video helpful, if it made you think differently about economics and your finances, subscribe for more content breaking down complex economic topics in understandable ways. I'm here to help you understand how economics actually works, so you can make better financial decisions. No hype, no manipulation, just education and information.
Thanks for watching.